Hello again. This is Joshua Carr at The Real Angle. And today I'm speaking with CEO and Chairman of Healing Realty Trust, Joe Caltabiano. Joe, how are you doing today?
I'm doing great, Josh. Thanks for having me. Excited to be here and talk some commercial real estate with you.
Thanks. Beautiful. That is the name of the game. So I'm glad to have you on board. Cool. So let's get right into it. I wanted to talk to you because I think what you guys are doing is interesting. So tell me what Healing Realty Trust is, and then we'll kind of get into it.
Sure, yeah. Healing Realty Trust is a REIT set up specifically for acquiring medical office buildings across the United States. We target high yielding assets that are fully tenanted with a nine cap in place. And we look to do some value add strategy by um, adding in psychedelic assisted therapy clinics as vacancies arise in some of these buildings.
Okay, so we got a few things going on there. First off, medical office yield of 9% is, shall we say, healthy. Obviously, the office industry has been getting slapped around pretty bad by work from home and the rest of it. Myself being probably a good example of that. How's medical office different than just good old fashioned office
Yeah,
office?
so medical office and especially healthcare really hasn't been disintermediated by the work from home phenomenon or whatever you want to call it. Phenomenon might be a nice word, but it really hasn't been disrupted at all by that. You know, you still have to go to the doctor to get your shoulder looked at. You still have to go to the dentist to get braces put on. You still have to go get blood work. So, the medical office in itself, the core business, is doing very, very well. Unfortunately, in times of financial hardships, you see a lot more doctor's visits. You see a lot more mental, physical, and behavioral health visits. So, patient experiences is up, which obviously, if you're on that business
Hmm.
side, that's a good thing. It might not be a great thing for the society as a whole, but certainly medical office continues to perform. We see very low vacancy rates in the areas we're targeting. We see very high performance. And as you mentioned, a nine cap in any type of commercial real estate is a healthy return, especially one that has
Sure.
low vacancy rate and good walls still in place. This is really a example of a dislocated capital market environment, limited buyers. The target range that we look in is kind of $3 to $15 million, so it's a little bit below where the large institutions and the large REITs purchase. Where usually these are local buyers, and we've seen a lot of the local buyers no longer have local banking connections. A lot of the small to mid-sized banks have gone. So now there's less relationship banking, which a lot of this price range usually is. So now when those people who
Sure.
bought properties over the years are walking in and looking for 70, 80% leverage and being able to sign on the dotted line to get the debt. Now it's personal guarantees, it's lower leverage points, it's higher rates, which again disrupts that buyer pool and then pushes these cap rates up in a pretty material way without being performance related, without being a distressed property, without needing significant capital improvements. These are all well maintained buildings that are really cornerstones for local markets.
Yeah, no, it's interesting. I mean, there's a lot there, but your comment about, the way banking has evolved. I mean, underwriting standards definitely have tightened. I mean, I work in the apartment building space, and I being asked questions by lenders that I never got asked before, asking for a level of backup that just was never there before. And I mean, not to be blasé about it, but there was a window of time in this industry when any idiot could get an apartment building loan, and experience was almost irrelevant. Whereas now they legitimately want to know that you know what you're doing. So that tracks of everything I'm experiencing from my own product type. Now the other thing, so the few other things I wanted to unpack there, the REIT thing is fascinating to me. I was on the board of a public REIT for around 5 years that no longer exists. Um, why the REIT structure? I mean, obviously I have my opinions, but like, why are you doing a REIT structure, and where are you in that process of setting
Sure.
up the REIT and all that kind of stuff?
Yeah, so I've had a long history in real estate. I've been on the sponsor side and I've been on the investor side. The nice thing about a REIT, in my opinion, is it's the most transparent, large scale investment vehicle for real estate. it really lines up the operating side of the business, the people who are going out and acquiring the properties and raising the capital with the investors, because it's a very transparent and pass through type structure. There's not the typical waterfall that exists in a GPLP structure where someone inevitably wins and someone inevitably loses. In a REIT structure, the management team is incentivized by stock performance, not by other things, not by some waterfall that kicks in if we hit a certain targeted return. It's really
Sure.
about creating that free cash flow. So I think there's some tax benefits to the REIT structure. I think there's
Hmm.
some things that, again, also with the goal and anticipation of scaling this up to a very large size, and ultimately, should capital markets improve from where they sit today, look to create a public opportunity here and create some liquidity for our investors. Where we're at
Well,
is we have, sorry, go ahead.
no, and that was one thing I wanted to clarify for listeners is that when we say REIT, the REIT is a tax election. It's a structure. It doesn't mean you're publicly traded. It's you're a private REIT to start, and then I guess what you're saying is if the markets move in the right direction, then the private REIT becomes a public REIT. Okay.
Yeah, exactly. And if you look historically, REITs have underperformed these last few years in a pretty material way to the rest of the market. Um, Everything in business and real estate that I've known happens in cycles. So certainly with it being beat up for the last few years, I think the anticipation is we'll see some improvement in the near future. Again, it's very hard to time capital markets. My focus as CEO and chairman of this company is just build a good company that creates a significant amount of cash flow. And with a REIT, 90% of the distributable cash flow gets pushed out to investors. So it's a very transparent, dividend focused kind of structure that we also anticipate some capital upside because of where cap rates sit today, the type of buyers or the type of sellers we're buying these properties from. And then as we can create some scale and also sprinkle some special magic when we introduce kind of our value add strategy of psychedelic assisted therapy clinics to add a premium onto the existing cap rate.
Now let's get to that because that is honestly, I mean, one of the reasons I wanted to talk to you today. The medical office REIT, I get it, I understand it. I don't want to say it's plain vanilla, but
Sure.
it's
You don't have
chocolate
to
chip.
talk to
I
me
mean, it's
about
not
that stuff.
totally,
Yep.
yeah, like that much I get. Let's talk about the drugs. That's
Sure.
more interesting. Explain to me what we're doing here. What are we
So,
doing here?
yeah, so my background quickly, I was in the mortgage banking space, a partner at a company called Guaranteed Rate in the residential commercial lending environment for a very long time. Then in 2013, I founded a cannabis company called Cresco Labs and grew that from a very small licensed operator to one of the largest cannabis companies operating in the United States, publicly traded, thousands of employees, millions of square feet of cultivation, manufacturing, distribution. So I've had my experience on kind of the leading edge of medicine. And I saw that industry develop in a very material way firsthand. Again, that sits on the federally
Hmm.
illegal side of drugs, right? With cannabis still being a
Right.
Schedule One drug for, we can go on why and how, and it's crazy that it sits there.
Illegal at the federal level. Illegal at the federal level. Legal on the state by state level.
Yep.
Yeah.
And everything
Sure.
we're doing at Healing Realty Trust is focused on federally legal psychedelic assisted therapy, which at its present time is
Okay.
only ketamine. So ketamine is a drug that's been around for a very long period of time. It was introduced in kind of World War II as a battlefield drug, and it's called a disassociative. It kind of puts your brain over here and your body over here. Twilight is a similar concept. So when you go in for various procedures, you're still awake. You're not intubated, but they can still kind of move you around and do some crazy stuff to you. So ketamine has been introduced for depression, for PTSD, and you've seen
Hmm.
a drug called Spravato, which is owned by Johnson and Johnson. So again, a federally legal drug that is insurance reimbursed. It's an
Sure.
intranasal spray, so it's a nasal inhaler. But what's unique about
Hmm.
this therapy is it comes with long duration talk therapy. So as you go in for depression or some of these terrible diseases that really become almost untreatable in today's society with the current drugs, where it's, hey, come talk to a psychiatrist for 30 minutes. Here's your prescription. Hope the drugs work. If they don't, we'll try something else. And hopefully you don't
Right.
get worse from some of those drugs. These psychedelic assisted therapy drugs are designed to kind of lower your inhibitions, be able for you to talk about the trauma that has occurred in a clinical environment. But with that comes 2 hours of therapy. So these drugs are introduced in clinic by physicians or by therapists. They aren't take home drugs in any capacity, and you need to stay there for 2 hours. So, what that's done is revolutionize the infrastructure need for your current psychiatrists and current practitioners. Because if your current visit
Got
is
it.
30 minutes long, you need a small room, you need the cliche leather couch or chair and a desk. Now, if you're adding 2 hours of therapy, it's a much larger space needed. You also have doctors and clinicians who've seen 15 patients a day. Now they can only see a quarter of that. So they need bigger space to
Sure.
continue to treat as many patients. So for us, the focus is going out. We've signed preferred agreements with a multitude of operators in the space who are looking to scale up their business because this is an insurance reimbursed business. It's 5 years worth of therapy. So these customers or these patients are very valuable. And once an office is full, they can just go open another one in a neighboring area. So we're seeing a lot of expansion. And as I mentioned, that drug Spravato, it went from zero revenue 4 years ago to now $1 billion drug. And it went from zero
Right.
clinic 4 years ago to 2,700 clinics across the country.
No, it's interesting. For what it's worth, I have a friend of the family who's a therapist who does this sort of like does this work.
Mhm.
And when I first heard about it, which was a few years ago, I'm like, what? Like it just came out of nowhere because it was not something I was on top of. And yeah, I've been watching it a little bit from the sidelines, just watching as this thing becomes a monster. Um, what's interesting to me about what you're saying, though, as far as the 2 hour thing and what have you, so it's really just more giving them more dedicated space that I guess is just, it's a different layout, though, fundamentally, right? I mean, it's still basically a therapist's office. It's just a different layout in terms of comfort, size of exam rooms, or size of facilities. Are there other things they need to do the to administer the drug?
Not really. It's a relatively straightforward administration. Again, it's intranasal for the
Okay.
insurance reimbursed. There is IV therapy that's a little bit different.
Okay.
It's more of a cash pay, it's off-label use. But again,
Got it.
it's
Okay.
not some giant surgery center build out. It is just really different, larger rooms. You might have a little more light deprivation. You might have a little more soundproofing in some of it, but a lot of therapy offices already have that. It's really not a
Sure.
significant capex environment. What's interesting for us is the taboo nature of drugs as they go from kind of unknown to mainstream. They unfortunately experience, opinions along the way by people who just have opinions from either knowing someone who've abused drugs, et cetera, et cetera.
Right.
With
Sure.
that comes the opportunity, unfortunately for the operator, but good news for us, is the large scale landlords aren't going to put this in the bottom floor of some commercial high rise in their marquee
Mhm.
building.
Mhm. Mhm.
So as you
Right.
have less and less landlords who will ultimately put these in place, there's a premium to rent for commercial landlords who will take on this type of tenant. So for us, again, we're buying in place, fully tenanted buildings that stand on its own 2 feet, and we're able to get traditional financing and good leverage on them. But as we have 3,000 or 5,000 or 7,000 square feet come available, we know a multitude of these operators who are looking to expand because I think inevitably there will be a roll up in this space in the near future because you've seen private equity roll up dental offices, you've seen them roll up
Sure.
all other sorts of medicine, and this won't be any different. So there's a rush to
It,
scale.
it's kind of like with dialysis. There are only like two major
100%.
dialysis providers, and then there's smaller ones, but all the smaller ones eventually get bought out by the bigger ones because that's
Yep.
just what happens. That's what
Yeah, and
happens.
then the
One
other the other
comment you made,
side. Sorry, go ahead.
yeah. No, one comment you made that I wanted to hone in on a little bit. You made a comment about because it's insurance reimbursement. There's like you made a comment about 5 years of therapy or something like that. What were you?
Yeah,
What
so
what
the,
did you
the
mean when you
current
said that?
REMS or risk mitigations for this type of drug, ketamine is a 5 year prescription, basically. So the standard of care is to utilize this for 5 years. So it's a
That's a
very,
long time.
yeah, I mean, but also most people are on their SSIDs for forever, right? You're on your Paxil or your,
Sure.
so it's and I unfortunately I don't know the typical time frame that someone is on an antidepressant, but I do believe it's basically the remainder of your life. The anticipation for this is a curative measure for depression or PTSD, and the expected therapy
Mm.
duration is over 5 years. So as these clinics
Yeah.
open, get a customer. My point of that is showing that it's a very stable revenue stream when you can when and these are tough words to use when you're talking about medical patients, but if you can lock in 5 years worth of revenue from an individual customer, the lifetime value of that customer is very significant. And then
Sure.
once you fill up your space, right, you only have so many minutes in a day, you only have so much square footage in your office, then you're seeing these clinicians or practitioners expanding into the town over and the town over and the town over so they can build out an infrastructure of this.
Sure. No, that's interesting. That's interesting. Yeah, and no, and it's fair enough to talk about lifetime value. It's not dissimilar from, say, I mean, it's different business, but dental practice. You keep going to the dentist, and it's not like you just go in once and you're done. So
Right.
same thing. Like once you get X number of patients, you just move on. So for you guys, so you're looking at obviously bringing in these tenants, getting these preferred, you've got these for preferred relationships, hopefully with these entities. And then I guess as they do a roll up on their side, then you basically go from having a low credit tenant to a high credit tenant, right? Because
Exactly.
eventually
Yep.
you end up with a credit rated guy in your space or something like that.
Yep.
Okay.
And the
Okay.
buildings we're buying, already have major tenants in it, whether it's a DaVita, as you mentioned, dialysis or Cardinal Health, or,
Right.
the buildings are anchored by true anchor national tenants. This is the value add approach. And then one other point I would make
Right.
about medical office is most medical services now that we receive as a customer are outside of hospitals. And that wasn't the norm 10, 20 years ago. Your GP was located in the hospital, your orthopedic was in the hospital. So now you're seeing the hospital systems push out these type of cares and all type of get well
Right.
medicine for more of the oncology center, for more of the ER, for more of the critical care nature of what a hospital is, just like urgent care, just like dialysis. All those things have been pushed out of the hospital. So for us, we target properties that are, depending on the metropolitan area, but somewhere between 1 and 5 miles from a hospital, in more of a medical corridor. We aren't focused on the very densely populated city environments, right? We're not buying these properties in downtown Chicago because, as you mentioned,
Mhm.
office has been disrupted by work from home. So, what we see in healthcare is the majority of these people are no longer going on their lunch break on a Wednesday to their doctor's office. They're doing it on the Monday or Friday when they're home in the suburban corridors outside of the large urban areas. So,
Got it.
in my
Got it.
terms of Chicago, it's more like buying in Oak Brook or Northbrook and some of the surrounding suburbs that might be, 10 to 30 miles outside, that don't have the large vertical vacancies that you're seeing in the densely populated cities, because we all know that those landlords that have those large buildings are going to do anything they can to move your mother, brother, uncle, sister, cousin, business, whatever, into there at very low rates, because they've got to start filling up what was going to be a hospital or going to be an apartment building or going to be something else. They're putting any
Right.
type of things in there. So, I think you're going to see some continued disruption of cap rates in downtown environments. So we're kind of focused on the large suburban, still large MSAs, but just not the biggest ones in the country.
No, look, that makes sense. I mean, all the data I've been looking at, like Seabury and the rest of the research guys are all saying office hits the bottom in 25, 26. Basically, it's going to get worse before it gets better, if we can even
Right.
believe that. Um, Now, where are you in the process as far as getting this REIT stood up? Are you fundraising now? Are you deploying equity? Like, where are you
We're
in the
doing
cycle of
both.
this thing?
So we launched our Series
Okay.
A fundraise, which was a $25 million
Okay.
fundraise. We closed the first tranche of that to go out and close on our first three properties. So we've actually closed on three properties. The
Great.
blended cap rate is about 10.7%. Average walt's about 4.8 years. First markets are Connecticut, Dayton, Ohio, and it escapes me, but in Texas somewhere. So We've
Okay.
closed on our first three properties. That's kind of indicative of the $150 million pipeline that sits behind it. Those areas, the Northeast, the Midwest, the Rust Belt, Texas, and Southwest of
Hmm.
Arizona, is where we're seeing aging population, good demographics that we look for, cap rates that we're looking for, and honestly, some aging sellers who are just tired. They're great buildings. They've taken good care of them for a long time, but they've seen value erode over the last 3 years. Their loans are coming due. They just don't want to deal with a new refinance. Banks are different. Everything's different.
Sure.
So we're
Sure.
seeing very attentive sellers right now where we can come in with some pretty aggressive offers and buy these things at scale. We've secured debt on all of our
Interesting.
properties ranging from 65 to 75 LTVs and kind of high sixes, low sevens. So accretive financing when you're buying properties at nine caps and above. And we're in the middle of that capital raise, as I mentioned. All of our REIT paperwork is
And
done. We haven't elected REIT status, but we anticipate doing that in the first quarter of next year.
with the next tax year. Yeah, and then from a financing standpoint, so you're just doing good old fashioned property by property debt financing. It's not like some portfolio financing or
Well,
something
so
funky like
we'll,
that.
we will, we've had a lot of conversations. We're working on some master credit facilities, but in the environment today, it's very much a show me story. You can't tell anybody
Mm,
anything. It's not raising money off a deck and certainly not getting a lender to jump without having
sure.
closed a property. So the concept was
Right.
go out, close on a few of these properties, get one individual by individual asset level debt. We will then continue on this capital raise. In addition, secure some kind of senior credit facility that we can ultimately scale up. They'll still underwrite at a property level, but we kind of understand the box and can plug um, deals into there. And then the next round will be some level of institutional capital raise once we've kind of proved this theory out and can execute it on scale.
Sure. And then eventually down the road, public markets and that sort of thing. So,
Correct.
so here's one more question I have for you, which is going back to really the beginning of this, which is, I don't want to say this idea is odd, but I will say it's unusual. What drove you to this one? I mean, you were coming out. I know you were coming out of the cannabis space, but like, what made you think that this was a good idea? And I don't mean that in a bad
Yeah,
way. Like,
yeah, yeah.
what
No,
you know?
so I think that a few pieces. I was pleasantly content, kind of exploring retirement. That really wasn't working, but I enjoyed the concept of retirement.
I
I've
hear
always
you.
had a passion towards real estate and finance, and I've also had a strong passion, obviously, towards the leading edge of medicine, having come from the cannabis space. I had a friend approach me, Cody Chandra and Dan Carcillo, who are founders of this company, and said, "Hey, we want to provide the infrastructure for the psychedelic industry." And I said, "That's great. The
Mm,
problem for you is these are small, non-anchor tenant type properties. And to say you're going to do a public REIT that's focused on 5,000 square foot standalone buildings is not
you'll
viable.
never get there. Yeah, yeah,
So your credit tenant quality is low, et cetera, et cetera." But as I dug into this, I recognized how disrupted a really good sector, which is medical office, is. And in this kind of $3 to $15 million range, there's really not many buyers. To be able to buy in place nine caps on buildings that are financeable at a material level, can get underwritten in this environment, and then to have a value add strategy that is not really heavy capex related. It's not like we're building a building or taking on construction risk or entitlement risk. It's if you have tenants to plug in and markets they're looking in, you can kind of be their master landlord in specific regions. Taking a building from a nine cap to a 10 or 11 is great in an environment that inevitably is going to see compressing cap rates. I think we'll be able to
sure.
maintain these cap rates for an extended period of time as these therapies become more and more mainstream. And then inevitably, if you look at the pipeline within the FDA, there's a multitude of other drugs that are going to come down this pathway. You will inevitably see MDMA, although the FDA shot it down in its first review of it just yesterday through Lykos
I saw that.
Therapeutics.
I saw that in
Yep.
the news. Yeah.
So,
Yep.
but
Yep.
it's there. It's being talked about, right? And the life cycle to get these drugs through and the indications will get shorter and shorter. So you've got ketamine today. Inevitably, you'll have MDMA. Inevitably, you'll have psilocybin because you're seeing too much done at the state levels, and they don't want another cannabis industry. And then nefariously, the pharma companies, their patents are running out on some of these mainstay drugs that are used to treat mental illness. So they need new
Sure.
drugs developed that are ultimately a new novel therapy to approach mental and behavioral health, because the current systems and the current drugs aren't working. The efficacy rates are poor. You're
Right.
seeing 22 plus veterans a day kill themselves from PTSD and other things. So there's a lot of things that need to happen to better our society as a whole. It's also somewhat of a bipartisan issue. Mental health is now, I was down raising money in New York last week, and we're down on Wall Street. Guys are on paternity leave. There's mental health days. There's a whole different look at
Sure.
mental health
Sure.
in
Sure.
today's society, and rightfully so. So there's going to be an evolution. So those things kind of led me to believe, hey, disruption in cap rate, credit still available for the right companies, growing sector and stable sector. That kind of lines up into maybe my next successful chapter in business.
No, and that's fascinating. It's funny your comment about not funny, but your comment about mental health and just the broader acceptance of it. It's my father was in a bad boating accident when he was young, and as a result, he lost his leg, and he's been had a prosthetic limb his whole life. And in the 1950s, when you lost a limb and you said that you still could feel the limb, that you had ghost pains, they just told you were crazy. And that's where
Right.
mental
Yeah.
health was at that
Yeah.
point. They're
Yeah.
like, you have ghost pains, you're crazy,
Yeah.
and stop talking about it, or we're going to drug the hell out of you. So
Sure.
and his solution at the time was just to say, no, doctor, I feel fine. Obviously, we have evolved. We've
Right.
realized that
Yeah.
there are things going on in the brain that we do not fully understand, and that we need to still work our way through these issues. So yeah, no, that's good. And your comment about it being bipartisan, it's funny to me. It seems like it might be the only thing left that might be
Yeah.
bipartisan. I remember a time when even things like infrastructure, like, it's a bridge. How can it be a left-leaning bridge or a right-leaning bridge? It's a bridge. And then
Yeah.
somehow bridges became partisan, and I'm just like, okay, like, guys, stop. Like, there's got to be something that we can actually
Right.
not kill each other over. No, it's fascinating. It's fascinating. Well, look, this has been very constructive. It's good to talk about this, and it's also good to talk about where real estate is on the cutting edge, so to speak. Um, I've covered what I wanted to go through. This has been genuinely interesting. For those who want to understand about Joe's business a little bit more, their website for Healing Realty Trust is healingrt.com, and you can read more about it there. And other than that, I'm just going to say good luck with the fundraising and the acquisition stuff. I've done it. I know what it's like, and you know, keep doing it. It's good stuff.
Thanks, Josh. I
Thanks
appreciate the
again.
time. It's always a pleasure to listen to you as well. So I enjoy the podcast. So thank you.
Beautiful. Thanks.